first to start, economic growth in Europe is notably softening. So this is the GDP numbers. They just got released this week from the Eurozone, and these are year over year change in real GDP. And Europe printed a 0.8% year-on-year increase. So if you think about it in terms of economic expansion and growth, like the closer you are to zero, that means your wiggle room is diminishing. Their economy has been in decline, not decline in terms of like negative real growth, but like slowing down rate of change of their growth rate, at least since Q2 of 2025. And you can see here the biggest like detracting force is really the imports of goods and services. So you see the purple lines start showing up. Those since Q2 of 2025, those are gravity pulling down. I know exports have, you see it in those 4 quarters since then. They're fine, I guess, but they're nowhere near keeping up with the pull from imports. And so it tells you the problems and balance of trade that are facing the EU. Let alone you can see it in the big kahuna, domestic demand, personal consumption, and all of that tied up in the blue. The big one, that's also slowing as well. So the slowing GDP growth is actually a headwind for your financial system, like your domestic financial system or your own, sovereign's regulated financial system. I know Eurozone's not a domestic, I guess is a term for it, but it crosses all these nation states. This slows down your ability within your banking system to expand credit, right? And so in terms of, this battle in the arena for cross-border capital, slowing economic growth creates a headwind for the ECB. Hence the urgency to release and move up the supposed ship dates of things like the Savings and Investment Union and the digital euro, whatever it is. Yeah.
So then,
Haven't seen it yet, but yeah, it's going to be great. It's coming. Trust us. All that. Okay, go ahead.
I would say, so then let's move on to money markets, right? So I think you had a way to tie this back towards kind of funding conditions, liquidity, etc. But I really, just for the audience to set this up, I think this is the meat and bones of meat and potatoes of what I think today's episode. Matt's done a lot of work on this, so Matt, I'm turn over to you. Take us through what you're seeing from this bill chart first, what we're looking at, explain what it is, and then take us through your whole narrative here.
Yep. I'm gonna just start from the standpoint. To me, this looks like we are past the seventh inning stretch, and we are in the deciding innings of the game at this point, eighth, ninth, whatever. And those can last a long time. We can take commercial breaks, pitching changes, whatever. But things are getting important, and money markets are flashing that signal with developments over the last 3 to 4 weeks since that U.S.-Iran ceasefire on April 7th. So where I want to start from here. So there's been a liquidity creation, right? It's shown up in asset prices and just a ridiculously strong, acceleration on things like the triple Qs. We'll get into that. But I want to know something I'm noticing. So short interest on ETFs, like short-term fixed income ETFs, like BIL, or there's several others in here with a lot of AUM, a lot of liquidity. Within the kind of the leverage complex of the securities industry, all your brokerage accounts. What I see happening is shorting of these low duration, which are also low volatility ETFs, and what that represents is a low cost source of cash funding for leveraged accounts. And just newsflash here, credit bubble late stage. We've been pumping this thing for 70, 80 years at this point. There's a lot of leverage. So the white bars here, though, that is like the dollar amount of short interest uh, in the bill ETF, and this is just one of several ETFs where this can be taking place. So you notice it's going up and to the right. This trend probably isn't done. Keep watching this, but you see it in the last cycle. So 2019 into March 2020 and then beyond, you saw this same effect. The leveraged balance sheets were tapping this liquidity. They'd short things like bill um, to raise cash as short-term interest rates were, as the yield curve normalizes, short-term interest will be the lowest yield out there, and then funding carry trades, pretty much any other asset, credit or like a new credit origination, new mortgage issuance, all of that, whatever, it's going to have positive carry, right? So the leverage, once you get into this state, the leverage wants to try to gross itself up. So you're seeing stuff like this as liquidity tapping within the ETF complex. Cameron, if you want to go to the next slide. All right. So something important is happening too to offset this, right? Because all of these levered players on the capital side of their balance sheet, they're levered, right? They're doing this on borrowed funds. They have debt service costs that are coming into the future, and it's well documented, well researched at this point. There's a lot of zombie balance sheets out there who a future rise in short-term interest rates or just level of interest rates across the board causes problems throughout all of this leverage funds architecture, and it exists everywhere, right? The entire offshore dollar, we talked about it. There is no lender of last resort. Your base layer is US Treasury debts, and you try to fund dollars from the dollar denominated invoiced global trade. So as the global economy goes into recession, that source slows down. Your last line of defense is treasuries. After that, I mean, modern day last line of defense is swap lines. Um, but that is kind of the state of the leveraged global dollar carry trade, right? All right. So what we've seen happening in SOFR since since April 7th, the ceasefire, has been like a revelation in my mind. Like this is huge going on. So I've got here four different dates for the SOFR 3-month SOFR futures curve. I actually got pointed to this by Tom Luongo, who as always usually puts you right over the target. So to see what's going on in the leverage system and the global dollar, all the geopolitics, all of that. As always, like that community helps me understand where the puck's going. So yeah, we'll just put that out there. All right. So I've got four dates here. I'm squinting, looking at my charts, a little small, but blue is on January 2nd. So to begin the year, remember the Maduro extraction took place on Jan 2nd. This is your SOFR futures curve in blue. Red would be February 27th, the day before the Iran operation. Purple is April 8th, which is the day after the US-Iran ceasefire, and then white is live data, right? So the way this works, the 3-month SOFR futures contract, if you're short, right, if you sell the future, what you're saying is, I expect the SOFR futures, like the daily average print on SOFR for the 3-month period at each of these contracts, backward looking. What we're saying here is I've got the charts are in terms of yield. If we see yields going up, right, what the futures activity is saying is someone is going to the market, they're selling these to hedge a risk that SOFR rises. So if you think about it, if you're, I'll get into it, who's the source of the shorts? It's leveraged funds. You can see it in the commitment traders report. They are roughly 1.5 million contracts net short. It increased like over 300,000 contracts in the last week alone. And then the offset there is the dealer community. So dealers are net long SOFR, so they're betting, hey, SOFR stays stable. We don't start seeing repo rumbles, SOFR market rise or SOFR rising, which is um, suggesting that money markets would pull the Fed towards, hiking to stabilize money markets, right? So if you go into that, you start, all right, leverage funds want to get short. What are they doing? Their liabilities at this point, most of their borrowing within the brokerage community, levered funds, all of that, it's going to be indexed to the money market rates. So there's about 10 trillion to 15 trillion dollars now in SOFR linked debt, right? We talk about SOFR killing off LIBOR. LIBOR has been rinsed, re-indexed, all of that. So 10 to 15 trillion, that's still a very small amount relative to the $100 trillion plus in credit outstanding within the U.S. economy. And then whatever the number is, just, they're all guesstimates, but a lot of trillions on top of that. So we're looking at maybe 10%, 5%, maybe as low as 5% market share total for SOFR linked debt, in the dollar system worldwide period. But if you're running some sort of strategy on leverage, right? These carry trades. Even your broker dealer's margin loan is going to be indexed to SOFR, right? If SOFR is rising, they're going to just overnight they'll increase their dollar borrowing rates, and they also may increase maintenance requirements to fund your margin loan. So you've got risk here if you're one of these funds who is in the business of borrowing on floating rate debt on the capital side of your balance sheet, the right side of that T table, and then on the left side you use that cash to lever up and buy assets and just thinking this global dollar credit bubble will just keep doing what's been working the last 70 years, but especially the last 40. So you see it. I broke this down into a few charts. The top is just nominal open interest, and you can see the shift as the leverage fund community gets either net short or next net long. I've just reversed the sign of the dealer's net position. They basically just fund whatever the leverage community needs, and then they'll go to other markets like swaps, um, other off balance sheet derivatives, whatever, to lay off their risk. Or they may buy a floating rate security like a Treasury to hedge their own risk of SOFR rising. And that will show up in 2-year Treasury floating SOFR spreads as well. But what you see here, as the liquidity taking exercise, say what's going on. We start this with the bill ETF. What's happening? The leveraged hedge fund community, this global carry trade, what they'll do is they'll tap the front end of money markets for short-term, low-cost liquidity, and then they'll see and they're going there and ramping up into this eighth and ninth inning of the money market cycle. And then they know long term their risk is interest rates rising. So then they'll short the futures because they're already short SOFR, right? Because their borrowing costs will go up if interest rates rise. They're helping create this phenomenon itself. They're bringing it into reality. So they'll go into the futures market, short SOFR, and then you see that bump start to emerge with yields rising. Now that time between money markets today wanting to stay low and then market or SOFR wanting to rise doesn't have to be whatever the SOFR, the hedging activity in SOFR futures, plots it out as. That's just balance sheet hedging activity. It's not saying the expectation is, December 2026 or June 2027. It's just these balance sheets, these firms, they're preparing for that risk. So they're structuring and positioning for that risk, it's somewhere in the future, right? SOFR is going to have to rise someday, is what the system is telling you. But that day may be further off, and we can make that thing last a long time from a structural standpoint. When I say we, I mean Fed, Treasury, commercial banks, et cetera. All right, and so I think maybe the last thing to get across, like you can see it in the 2-year future when the leverage funds start to hedge and go from net long to net short. That's your sign that yields ultimately want to start moving up. And so if you just look at these trends, just I'm on the middle chart following starting with mid 2020, the levered funds getting longest of longs. You could say it even goes back a little earlier than that, Cameron, but then you draw the line. That was the positioning headed into 2022 as interest rates finally broke and started to rise. Then once the levered funds start getting less net short from 2022 to 2024, that's kind of the all right, yields are still going up, but they're getting less bad. So you think about second derivative matters here, rate of change. You got a first derivative negative, second derivative pushing up. Eventually, you get to some stability. And then we start seeing again since mid 2024, you've got 2-year rates, they went through a period where they settled out, after that aggressive, rate hike cycle from March 2022 all the way into, I want to say, it was September 2024 when we got the first cuts, I want to say. So 2 years of stability, and then you get into cuts in 2024. You start going more negative into mid 2025, and then now you're starting to see this effect where the levered funds are hedging their risk within money markets of higher interest rates. That's creating that future that next upswing in rates, but that thing still might be years into the future, right? This can stay here for a good amount of time before the Fed has to do anything. And their ability to stabilize money markets really depends on the resource constraints within the economy, right? So if you want to print $6 trillion in, say QE again, and your resource inputs that are driving economic growth are right up against the boundaries of the economy's capacity constraints, that $6 trillion is just going to flow into, it's just going to slosh around in supply chains that are at capacity, all of that stuff. And that's where, yeah, the CPI prints and the PPI are going to be to get a hold of those and control those will largely determine how much kind of flexibility the Warsh administration has to navigate this period that we've crossed into this eighth and ninth inning.
Matt, let's go through the SOFR swaps here. You mentioned this is a way for some of these brokers to offload some of their risk. What does that mean?
Yeah, dealers, right?
Dealers.
Yeah, so your primary dealers are going to be, mainly like some of them will be pure brokerage, but some of them are attached to, the commercial banking system as well. All right, so same way we showed you the CME SOFR futures, and you saw that pressure building from the hedging activity in the leveraged funds complex. That's somewhere on the horizon. This is the SOFR swaps market pricing. So what this is, banks, financial institutions, hedge funds, et cetera, just large institutional, financial intermediaries, they can go into the swaps market and lay off or add SOFR or floating rate risk, and it'll come at the variable here is going to be a fixed interest rate on like they call it the fixed leg, right? So these swaps, what you're doing with your counterparty is say if I buy the SOFR swap, what I'm going to do is I'm going to receive SOFR, pay the fixed leg, right? So if I, as a dealer, went in and I went long SOFR to provide the I went long SOFR risk to provide the leverage fund that short position that they wanted to access to hedge in the futures market. I then would go lay off that risk in another market, say swaps, right? So I would then I need to get short SOFR too, right? To balance out my cash flows risk. And what I do then is I'd go sell the fixed leg. So what you would see then in the swap market is these fixed rates start to come up, and then these fixed rates are actually it's not it's not theoretical pricing. Like these are deterministic. You just plug in the Treasury zero coupon cash flows at all of these maturities. You plug and chug, and you get what you get, right? Like it's a very clear arbitrage transaction. Um, so the rate that the dealers can lay off of their SOFR risk that they're piling up in the futures market will depend on the treasury markets, the sovereign debt rates, right? So it's inflation expectations, real economic growth, all of that that are at the end of the day your binding constraint. All right. So what we've seen, same thing with SOFR over the course of the year. You've seen some really big developments on the you know anywhere from like 6, 9 month all the way out to let's say 2 years outlook for what all of these players are suggesting with their hedging activity that they're seeing around the corner for future developments. And it's really, you see the bounce here starting, yeah, it actually goes down, right? So we're saying, oh, this is deflationary or disinflationary or positive for growth, the Venezuela action. But then from February 27th, the operation, what is it called? Epic Fury.
Epic Fury, yeah.
Yeah, you get a bounce. These fixed legs go up to ceasefire day, April 8th, and then from ceasefire day till now, you've got another leg up between the red and the white. So the cost for the dealers to hedge, it's diminishing, right?
Right.
It's about 70 bips of capacity that's been chewed up. If you think about like the move when you start to look 2 years out, that number, what you're looking at there is the profitability for providing liquidity into this hedging risk that the leveraged funds, all this giant credit bubble that's out there, asset bubble that's out there, all of that, your ability as a dealer is to fund that risk. Your ability to lay off and all of that is diminishing as sovereign debt interest rates rise. So the rubber will meet the road. We'll find out who wins this tug of war. My interpretation of what's going on. So you see bills pricing on the front end. So talked about the 3 month, 6 month auction on Monday. For the last 2 weeks, or prior 2 weeks, it was flat, which was the end of the record, like 2.5 year inversion in money markets. And that 3 month, 6 month, simultaneous auction flipped to normalized. And then you're also seeing, if you look at 4 week treasury bills, look at those auctions every Thursday, start to follow things like the low rate. As that comes down, what that's saying is that flight to safety of the short-term T-bill, it still exists despite all the de-dollarization narrative out there. The front end money market, like they're still going after risk-free collateral assets. As kind of the music slows down as we get into that eighth and ninth inning. And you can also see it. We talked about the SOFR futures, but if you look at the first contract, the actual one right in front of us, they're not selling that one, they're buying that one. So yields are coming down on the front end. And so this is a big development. tells you where this thing is going. And so you see the yellow there. We're in a window. Like since rates have been cutting, right? September 2024 was the peak, if you look back on it in this cycle, of those 2-year Treasury floating rate note SOFR spreads. Those are coming in, and then as we're seeing the short interest hit the SOFR curve, you're seeing this same pressure, the little yellow arrow on the right. Those 2-year SOFR spreads want to come down as there's that flight to quality. It's not duration, right? Because we're in an environment. This isn't 40-year bond bull market, 1982 to 2021, of fixing the system every time it wants to go into a spasm of lowering interest rates and then increasingly monetizing the credit bubble by putting it on the Fed's balance sheet. We're trying something different now. And then that whole thing we got at Clarity, that Morgan silver dollar transitioning to or evolving to its new final form as a Pokemon, right? It's leaving behind its material, metal atoms and taking on these bits. But this is not the same, process we've become used to since like 1998 LTCM,
Right.
Fed bailout in 2008, Fed bailout 2020. So be prepared that the game itself may look different in terms of Fed behavior, Treasury behavior, and then global dollar system behavior for however this this thing evolves in the quarters and years ahead.
Okay, so Matt, let's move now to what we're seeing in the actual equity markets. You alluded to this previously in terms of, ripping in S&P, ripping in Micron, etc. So you've got here the Qs. Maybe explain to us, how does this relate to the money market piece that we are talking about beforehand?
So that we talked about the liquidity tapping on the front end, things like you're seeing it show up in things like the short interest and the market value, the cash proceeds of all that shorting activity on, bills and other, fixed income ETFs. And you can do this, throughout, fixed income complex. If you're shorting interest rates into rising yield curves is profitable, but as we know, lower duration is lower standard of deviation, less chance that short could result in you losing money. So all of this is creating liquidity, right? It's grossing up balance sheets within the leverage fund complex. These leverage funds, they don't have the ability to do anything other than buy something with the proceeds of that cash. So what they just do is they'll just keep buying the longer than that they were already long. So you just get longer. So that's why, in my opinion, we see this jerk on the chart of things like the secular AI growth trend, the semiconductors, Micron. Like if you zoom out on the Micron chart, like it is an elevator. But that observation in the triple Qs, the semis, AI inputs, memory, etc. That's a key tell of exactly what's happening within this leveraged fund complex universe. And so where the rubber meets the road for Fed policy then is what's going on with prices in the real economy. Like if you're at your resource constraint, right, and your economy isn't able to further, expand, say, production of the things the economy needs to deliver growth. That's where you're pushed into the corner, and what you would have to do to maintain monetary stability is hike rates, right? So the Fed, Treasury, all of that on the front end of the yield curve, they're heavily dependent on the fundamentals of the economy itself. And then as you're seeing with China, it's not just and Venezuela, Iran, et cetera. It's not just, the domestic 48 or, 50 state US economy, right? It's the entire regional orbit of access to resources and trade within the new dollar system framework, which includes commodities in Venezuela, Argentina, higher good production out of Japan, et cetera. This new regional sphere that's coming into being. So key thing here in the CPI report from April came out this week. We saw a hot print. down in terms of the month-over-month impulse from March, but still elevated, right? So you still have the elevated CPI problem. The contribution from energy, right, that oil supply shock, that dissipated with the ceasefire giving a temporary breather into the tightness in energy commodity supply chains. And then you see that yellow bar on top. That's the core services component. Um, that segment increased in contribution in April. And if you look into the crosstabs, right, on what is going on here in the BLS's data collection process. It's largely driven by owner's equivalent rent, right? The line item for shelter. Um, it's a made up number. It's not reflecting any market-based financial transactions. It is purely survey-based where a government bureaucrat goes around, asks 1,000 households or whatever, hey, what would you charge if you had to rent out your primary residence? It's a made up number, right? So um, what this is really telling me, everybody knows, obviously, there are price pressures within the grocery store. You're going to the gas pump, et cetera. We're all feeling it, but it remains to be seen in the months ahead whether this is actually kind of that secular pressure towards the boundaries of our economy's uh, capacity to produce these inputs that we cobble together and deliver growth. But this is the like where the rubber meets the road on are rates going to have to rise or not. So there's a lot of wiggle room. There's a lot of game left to be played. Is I think the thing to be pointed out here. And you saw very similar findings or behavior in Wednesday's PPI report for producer prices. Just to cut to the chase, what was the driver here? It was coming from transportation and warehousing of goods. So higher diesel prices, trucking capacity constraints, et cetera. Um, it's largely tied to here, this big markup in PPI, this impulse. It's coming in that transition from producing a good at A and getting it to its destination for final consumption B. That is the problem in PPI. So the data here is showing like there is a very clear roadmap of the problem that needs to be resolved, ties to energy resources, supply chains, distributions, all of that. And I think from government standpoint, they know the work that's in front of them.